Right now, shares of Applied Digital Corp, ticker APLD, are trading live at $28.76. That is a sharp move down, a drop of $2.68, or about 8.52% on the session. And this is happening on very heavy volume, which has already crossed 4.3 million shares, well on its way to pacing above its daily average. Now, the second you see a chart like that, a stock that has been a rocket ship, up over 300% in the past year, and it suddenly hits an air pocket like this, your first instinct is to ask what broke. And today, we know exactly what's causing the pressure. The company just announced its subsidiary is planning to offer $2.35 billion, that's billion with a B, in senior secured notes. And there, in one sentence, you have the entire story of this stock, the tension that defines every single trade, the expectation of an AI-fueled future versus the crushing immediate reality of what it costs to build it. Most people looking at APLD, checking it on their Robinhood app or managing it in their Fidelity brokerage account, see it as a pure play on the AI build-out. The story is simple and incredibly compelling. You look at NVIDIA stock and you see the company making the shovels for the AI gold rush. But where do all those shovels go? They go into factories. Applied Digital, the market believes, is building those factories. It's moving from dirt to compute, constructing and leasing out massive high-performance computing data centers. The expectation is that this is a guaranteed growth vector. The reality, as we're seeing today, is that building those factories requires a truly staggering amount of capital. That $2.35 billion note offering is explicitly to fund the construction of the next phases of these exact campuses. The market is now grappling with the fact that APLD is, at its core, a capital-intensive construction and real estate play that is financing its growth with debt. This is a very different risk profile than a software company. The recent fiscal first quarter 2026 earnings report, which came out in October, gave us a clear preview of this. Revenue was fantastic, coming in at $64.2 million, an 84% jump year over year, and a solid beat of expectations. But the costs were eye-watering. Cost of revenues shot up 144%, and SG&A expenses ballooned by 165%. This is the price of rapid expansion. They also posted an adjusted net loss of $0.03 per share. Now, that was actually a beat. Analysts were expecting a much wider loss of around $0.14, but it's a loss nonetheless. The company is not profitable and is burning cash to grow, funding the gap with a $5 billion preferred equity facility from Macquarie and now $2.35 billion in new notes. This is what makes online investing in a stock like APLD so difficult and why it's not for the faint of heart. The stock's volatility is extreme. Its beta is over 6. Many traders on platforms like Interactive Brokers, which are built for active traders, love this name for that exact reason. You can't just buy it and forget about it. It demands daily attention. You have to weigh the bull case, those $16 billion in contracts, against the bear case, the mountain of debt, the insider selling we saw reported earlier in the quarter, and the sheer execution risk. What if they can't build these advanced liquid-cooled facilities on time and on budget? The company claims it can shorten construction timelines from 24 months to just 12 to 14 months, which is a key part of its advantage. But any delay, any cost overrun, a supply chain snag for a liquid cooling component, a labor shortage in North Dakota could be catastrophic when your balance sheet is this leveraged. This is the kind of situation where investment help from a professional might be warranted, or at least a deep, honest assessment of your own risk tolerance. This isn't Apple stock or a broad market Fidelity ETF. This is a high-stakes bet on a single company's ability to execute a difficult transition. Let's be clear about what Applied Digital is and what it was. This company was, until very recently, primarily a crypto hosting business. It provided data center space for Bitcoin miners. That was a good business when crypto was booming, but it's notoriously cyclical. The leadership, seeing the AI tidal wave, made a strategic decision to pivot. They're using their expertise in building data centers to chase a much larger and hopefully more stable market, high-performance computing for AI and cloud customers. This is an admirable and intelligent business move, but it is also a complete transformation. They're essentially building a new company from the ground up, and that new company has an insatiable appetite for capital. The old crypto hosting business is still there, providing some cash flow from its facilities in Jamestown and Allendale, but the entire stock valuation is now based on the AI hosting future. This is what Wall Street is underwriting. The analyst community, for what it's worth, is almost unanimously bullish. We're seeing buy ratings from Needham, Craig-Hallum, Northland, and others with price targets clustered in the $37 to $43 range. They are clearly focused on the $16 billion in contracted revenue and are willing to look past the near-term cash burn and debt. They see the $11 billion contract from CoreWeave and believe it de-risks the entire model. But individual investors, whether using a Schwab Intelligent Portfolios robo-advisor or a hands-on individual brokerage account, have to be more cautious. The stock, even after today's 8.5% drop, is still massively up. The question is, what's priced in? Is an $8.7 billion market cap appropriate for a company that is still reporting net losses, even if it has massive contracts? Or is it cheap, given that those contracts virtually guarantee a decade of revenue? This is the central debate. I want to know what you think. Comment below. Are you more worried about the $2.35 billion in new debt, or are you more excited about the $16 billion in new contracts? Let me know your take on this. Looking forward, the path for APLD is binary. The bullish scenario is that this debt offering is the last big delusive-looking capital raise they need to do. They get the financing, they complete the Polaris Forge campuses, the revenue from CoreWeave and the other hyperscaler starts to flow, and the company transitions from a cash-burning construction story to a cash-flowing AI utility. In this scenario, adjusted EBITDA, which was only $0.5 million last quarter, would explode higher as the high-margin leasing revenue comes online. The shorts would be permanently defeated, and the stock would be re-rated, potentially trading at multiples closer to other data center REITs, but with a high-growth tech premium. The bearish scenario is what's on display today. The debt load itself becomes the story. Every interest payment is a drag on potential profits. Any hiccup in construction, a delay in permits, a supply chain snag for a liquid cooling component, a labor shortage in North Dakota, gets magnified and creates a crisis of confidence. If the market starts to believe they can't execute, the stock will collapse under its own balance sheet. Furthermore, there's a significant counterparty risk. The company's entire future is tied to the health of CoreWeave and one other client. If anything happens to them, APLD's $16 billion in guaranteed revenue could be in jeopardy. This is why this stock is so fascinating. It's a microcosm of the entire AI boom. The expectations are boundless, just like they were for Tesla stock in its early days. But the reality is grounded in hard, physical, and expensive things: concrete, steel, fiber optics, and power that must be paid for today with the promise of profits tomorrow. Today, the market is blinking. It's looking at the $2.35 billion bill and feeling a moment of profound sticker shock. The expectation was a smooth ride to AI riches. The reality is a leveraged, high-risk construction project. The bulls will say this is the time to buy the dip, to get in while others are fearful. The bears will say this is the first crack in the dam, a sign that the cost of this AI build-out is simply unsustainable. For now, the stock is reacting to the immediate dilution and debt, a perfectly rational response. The long-term story, however, is still being written.